Hello, I'm Luis Quinones, and we're going to be going over decoding financial statements, interpreting your business health. This is a body of work that I think all entrepreneurs need to kind of know how to interpret their financial statements, decode them. It's the root of kind of understanding your business and really whether or not you're making a profit, which is essentially why we're all in business. Our agenda today is going to basically be financial statements. We're going to cover all three key statements: the balance sheet, the income statement, and the cash flow statement. Accounting fundamentals, which we're going to explore some of the basic principles and concepts of accounting, such as double entry bookkeeping. I'm going to try to explain that as best as I can, and the golden rules of accounting. And then more importantly, some practical applications, analysis of financial statements, and a case study that we've got as well. Just a little disclaimer, this presentation is not professional advice. It's intended to help you understand the area of law and prepare questions for a certified public accountant. Do not rely on the information presented today, as it doesn't replace professional legal advice or create an accountant-client relationship. Consult a licensed legal professional in your area for assistance. Okay, financial statements. What are they? Financial statements are the essential tools to evaluate a business health. Why do they matter? Well, in business, you always need to know how the business is doing. You may want something at a point in time. You may want something over the long term, how it's been doing. But these financial statements give us the key tools for assessing that financial wellness. It enables you to make a sound decision, and so they definitely help in the sound decision-making process. And if you're so inclined to do so, whether it's a business loan or looking for outside investors, angel investors, or just even a small, simple SBA loan, usually financial statements are key and crucial to making sure that you're able to present that and give them the temperature of your business health, if you will. The big three financial statements, what are they? Well, there's an income statement, and that shows the business of profitability over time. So it's a scorecard, basically, in terms of how you're doing over a certain period of time. Most financial statements, they can either be monthly, quarterly, or yearly. So again, there's a stretch of time there that you're really looking at the profitability of your business. That's probably the one that most people are familiar with. A balance sheet is a financial statement. It's the second most important, I would say. It's a snapshot of all your assets, your liabilities, and equity. It's a snapshot of your business and how it's doing at a point in time. So income statement does profitability over a period of time, and a balance sheet is a snapshot at a point in time. Cash flow statement tracks cash in and out of the business. And so essentially, we all know what our checking account looks like, and that's essentially what our cash flow statement is trying to do. It's trying to get a handle on what our operating cash is looking like. And why is it important? Well, you want to make sure that you pay the bills. You want to make sure that you have enough cash on hand to be able to pay for today's business and make sure that you've got enough in the bank to continue on over the long term. Okay, so let's take a look at the income statement. It's known as a profit and loss statement. People just call it a P&L. The purpose, again, of this particular statement is to give us a measure of profitability over time. Key terms in the income statement that you'll see at the very top line, the sales line. It's income. No business in the world exists without sales. So that's what we're in business for, right? Trying to make sales. At the end of the day, we also have cost of sales or cost of goods sold, which is basically supplies and material, cost of labor and storage. It's everything that goes into what we're actually selling. That comes down to another line, which is basically termed gross profit. That is revenue minus cost of sales. And then we're down to what you see as generic expenses in the income statement. Those are actually known as operating expenses. Those are costs not tied to production. Usually those can be defined as office and G&A, or general and administrative expenses, which includes office staff wages, owner's compensation. And then you've got employee expenses. In a service business, this is extremely important. Employees are the reason you're able to get stuff done in a service business, is because you've got employees actually servicing those accounts, or you've got them doing whatever it is that your deliverable is. So employee expenses are a huge piece of the particular operating expenses. As you go down through it, you've got your taxes and license, vehicle expense, subcontractor expense. Up top, you've got the office and G&A. That's considered overhead as well. So you get down to the bottom, and you're looking at the net income. And again, bottom is operative here because it's the bottom line profit, which is your net income. That's what you're trying to get at. The next statement, as I mentioned, is the balance sheet. The balance sheet provides a snapshot of your financial position at a specific point in time. There's a real famous equation in terms of accounting, and it's actually called the accounting equation. And that equation is assets equals liabilities plus equity. So your assets, the way this particular balance sheet is broken out, all balance sheets are broken out, is you've got all your assets up top. In this particular example, they total out to be $183,071.69. And then you've got your liabilities and equity. So what is this stuff? Let's talk about it. Assets are resources owned by the business. So that could mean anything with regards to vehicles, office furniture, machinery, and equipment. Those are considered assets. Those are resources owned by the business. However, you can see up top that the very first asset that's listed is your bank account. That's a position in terms of what your bank account or your cash position is on the business. Why is that important? Well, I used to have an old professor that would always tell me, cash is king. Cash is king, why? Because cash is what allows you to pay the electric bill, fund your payroll, whatever it is that you need. You always need to keep an eye out on your cash position with regards to the business. Second line item you've got there is accounts receivable. This is work that's already been done, and we're now waiting payment to come in on this particular business. So that's another piece, and that is considered an asset because it's a bill that you've already invoiced someone for, and you're waiting for that money to come in. The rest of it are the fixed assets, the machinery and equipment, office and furniture, vehicles and trailers, and you've got all your fixed assets there. The next piece are liabilities. What are liabilities? Liabilities are debts or obligations that the business actually owes. Accounts payable is the money that is owed by the business. That could be supplies or material from a vendor, anything that's basically utilized that we've basically purchased on credit, that's probably in accounts payable. You can notice there as well, I use the word credit. Right below that, you've got credit cards, and you've got other current liabilities. Current liabilities means that it's a liability that's owed and it's current. Current means less than a year out. It's not a long-term liability. It's less than a year out when you talk about current liabilities. The next one below that is long-term liabilities. And you can see that these are longer term because these are probably loans that are a little bit longer than a year. So there's a difference between current and long-term, and that is usually the 12-month period that is within a year. Anything that's owed over a year term is considered long-term. Anything that's owed within the 12-month cycle is considered current. In this particular example, we've got our GM Financial Silverado, and so it's probably owned through GM Finance. We've got Mitsubishi, and so we're paying on those notes. We've also got a loan through Square that looks like was entered in June 10th of 2024. Long-term liabilities total for this particular business is $141,000. Now I'm going to reference something here. Our total assets here are $183,000 and some change, and our liabilities right now are $141,000. If you look at our formula, assets equals liabilities plus equity, we're not equal yet, right? We need to basically make sure that we're equal. So liabilities is one piece of the bottom half of the balance sheet, but now you've got equity. What is equity? Equity is the owner's stake in the business. I'm going to argue that it's not just the owner's stake in the business, but it's also a value proposition of what it is that the owner's actually doing for the business, what he's taking out, what he's putting in, and it basically comes down to making sure that we've got an equity position to make sure our balance sheet equals out. So let's go down the list. Estimated taxes in terms of equity can be considered a negative because that is money that's going to basically be coming out, and that's taking value out of the business. So those are estimated taxes that are owed for $29,488. In this particular example, we've got an owner's draw of $13,825. So what is that? That's basically money that the owner took out throughout the year within this period that is going against the equity portion of the balance sheet. So that's also noted as a negative. So that's money that's taken out. And then we've got retained earnings of negative $64,396.06. Retained earnings is kind of a accumulation account of all the equity that's basically been accumulated over time for this particular business. In this particular case, it's negative $64,000, but we've got net income as of October 31st, we've got net income of $149,025.09. So I'm going to posit something here. The $149,025.09 is not listed as an item here in the balance sheet. It's not being driven by anything. That's actually going back to the profit statement. or the profit and loss statement. You can see down here that the net income, 149,025.09, is exactly where our net income is for the January through 2024 period. And that line item flows through as the final item on the balance sheet. And that actually puts our total equity in a positive mode of 41,315.14. And now we've completed the formula, 183,071.69 worth of assets to 183,71.69 equaling the liabilities and equity account. We're now in balance, if you will. Cash flow statement. Well, the cash flow statement, again, is a very, very crucial statement, and it's good to know, like I was mentioning before, cash is king. Your income is always being looked at, as well as your finances and kind of what it is that you owe on the particular business. The cash flow statement's a little different because it's taking your operating activities along with investing activities, financing activities, and it's giving you an idea of what your cash either increase or decrease is for a period of time. What it does is it monitors the business liquidity and the sustainability. By sustainability, I mean how much longer can you keep the lights on for this particular business. So in this particular case, you can see that we've got net income. We've got some adjustments to net income, to net cash provided by operations, such as the vehicles, trailers, the 22 Silverado, accumulated depreciation, and we've also got our gross receipts tax payable. We're in the state of New Mexico, we pay gross receipts tax. Total adjustments to reconcile net income is negative $69,515.69. That basically provides us with, out of our net income, providing us with $79,509.40 in net cash provided by operating activities. Then we've got some investing activities here, which is essentially the vehicles and the trailers, which we purchased on June 26th for $60,000. And then it looks like we might have sold a Silverado for $68,995. So we got a negative $8,000. And then we've got all of our liabilities, which we referenced on the balance sheet, to come down to net cash provided by financing activities of negative $26,000. Our net cash increase ends up being $45,440. We tie that, or we add that to the cash at the beginning of the period, and we end up with $54,764.57. So this particular cash flow statement is extremely crucial because this shows the liquidity of the business and whether or not you're able to continue to operate and finance your core activity over the rest of the long term, if you will. Cash flow is crucial for daily operations. Again, I can't state that enough. Unlike profit, which doesn't indicate cash availability, cash flow does, because it's taking into consideration your investing activities, all your financing activities, so there's a lot of ins and outs that happen. You want to have a good position on your cash. How these statements interrelate? Well, as I mentioned already, net income flows into the balance sheet's retained earnings. Cash flow statement starts with net income from the income statement and ends with cash at the end of the period. As I mentioned before, that is part of the balance sheet. So they all interrelate. They're all scorecards, financial statements that are crucial in terms of giving you the temperature of your business. Okay, the two methods of accounting. There are two different methodologies that are followed in our business world. And the two methods are cash methodology versus accrual accounting. That's a whole other methodology. Let's talk about that a little bit. We're all used to using cash. We know that when we make money, we get cash. We know that when we spend money, we lose cash. That essentially is cash accounting at its crux. Cash accounting, basically, what you're doing is as you are receiving monies or you're being paid by your customers, you are essentially accounting for that particular sale the day you receive that particular money. Cash accounting also provides a simpler method in terms of your expenses because you account for that expense at the point that you are paying for that expense. So again, very direct. Cash in, you make the entry, that's a sale. Cash out, more than likely that's an expense or a liability payment, and you make that particular adjustment on the ledger. Accrual accounting is a little different, so let's talk about that. Accrual accounting, what it does, it records revenue at the point that it's earned, and expenses are basically recorded at the point that they're incurred. You'll notice that I didn't mention cash changing hands here at all. So again, accrual accounting records revenue when the revenue is earned, and expenses are incurred regardless of when the cash changes hand. Accrual accounting gives us a comprehensive view of business financial health, tracking receivables and payables. So let's go a little deeper in terms of the accrual accounting. If you own a manufacturing firm and you make a widget and you basically are 50% done with that widget, it's not complete yet, you cannot account for that particular widget as a sale yet. Once it's sold and you've got an order, that basically creates what's called a receivable. So you know that this particular widget is off to the customer, but can you track it as a sale yet? Is it revenue? No, you can't. You have to track that particular revenue at the point that it's earned. And I'll give you another example or to continue on with this example, with regards to the manufacturing firm, you can actually account for that particular revenue at the point that it's shipped off and you know that that particular product has been completed, and now once it's shipped off, now you've earned that particular revenue. That's considered an earned revenue, and the expense is basically something that you're keeping track of, and when you actually pay those bills out, you're not necessarily accounting for those bills immediately when it's expensed. You're tracking that on accounts payable. Accounts payable and accounts receivable, if you're tracking those, you have to do accrual accounting. The golden rules of accounting. I'm not going to get into too much detail here, but to give you a little bit of background, understanding the double entry bookkeeping standard is essentially the fact that every transaction has two equal and opposite effects, a debit and a credit. The total debits must always equal the total credits. You always have to maintain the accounting equation, so your balance sheet constantly needs to reflect A equals L plus, the way I was taught it, OE, which is A equals L plus owner's equity. In this particular case, it's assets equals liabilities plus equity. That always has to be balanced and true for the financial statements to be accurate. Keep in mind, the balance sheet has the net income component down at the bottom line. Classify transactions correctly. Classifying transactions correctly, I would say, is the crux of everything with regards to accounting, because at that particular point, when you're actually bringing in this particular activity, whether it be from the check register or you're reconciling the bank account or you're really just logging in bills, transactions must be categorized as either assets, liabilities, equity, revenue, or expense. At that particular point, when you start categorizing, you need to make sure that you're categorizing them in their correct line item. Everything has a home, and that basically ensures the integrity of all your financial records. To go into a little bit more of double entry bookkeeping and ensuring accuracy and balance, what is double entry bookkeeping? Double entry bookkeeping is a system where every transaction affects at least two accounts, ensuring the accounting equation stays balanced. So in other words, if you have a debit on one side, you have to have a credit on the other. That's always the case. It maintains the balance of the accounting equation, ensuring that financial records are accurate and reliable. How it works is debits and credits. Every transaction is recorded in two places. A debit is on the left side and a credit is on the right side. The benefits are accuracy, transparency, and a comprehensive financial picture. Double entry bookkeeping, ensuring the accuracy and balance. In this particular example, we've got an account title, and it's a debit. You can see the T account. This is what all old accountants use, is our little T account. And we've got a debit and a credit. The debit is represented on the left side, and credit is represented on the right side. That's always the way a T account guide works. Not only do you have the double entry bookkeeping in terms of the T accounts, but you've also got the general journal, which is where you've got all of the other information that is referenced when we're actually going through this. Account types and their balance. Each account type has a natural debit or credit balance, guiding how we record increases and or decreases. Assets and expenses. The rule here for assets and expenses, in order to increase an asset or an expense account, you need to debit that particular account. It's a debit to increase. It's a credit to decrease. A good example of that would be buying equipment. You would be debiting the asset you've incurred or you've purchased equipment. So that's an increase to your equipment line item. So you're debiting that asset. That's an increase to an asset class. And then you credit cash because that's a decrease to cash. Also an asset, but you have to account for the decrease. and you have to credit that particular asset. I know that can be confusing because you're saying credit to decrease, but that's just the hard and fast rule with regards to double entry bookkeeping and how you handle assets and expenses. Liabilities and equity. The rule for liabilities and equity is to credit to increase and a debit to decrease. So again, that makes a little bit more sense in terms of our everyday speak, where we're crediting something to increase it versus debiting to decrease. A good example of that would be a loan. Now, what happens when we take a loan out? We end up getting cash. So we need to increase our cash asset. That would be a decrease, that would be a debit to the cash asset, and we would credit our loans payable, which is a liability on the balance sheet. Revenue is a credit when earning income. So in other words, if you have sales, you credit that particular income or sales line item, and you debit it, for example, if you have a reduction. So if you have a refund, for example, you would end up debiting that particular line item. Now, making a sale, like I said, you debit cash because you're getting an increase in your cash, and you credit sales because you're increasing your revenue. So bringing it back to cash is king, you got to make sure that you run that sale through your cash account, increase your cash, credit your sales revenue as well. What are T accounts? Well, T accounts are the skeletons, if you will, of an accounting system. They're a simple visual tool used in accounting to represent individual accounts, making it easy to track debits and credits. You've got a full T account that you can represent as an asset on the very top line item. You can see here on the very top line, you've got assets equals liabilities and owner's equity. That is the T accounts at a top level. And then you've got under owner's equity, you've got paid in capital and retained earnings. Again, those are all equity accounts. And under retained earnings, you've got expenses, revenues, and dividends. Each T account is shaped like a letter T. Left side is a debit. That records an increase for assets and expenses. And on the right side, it's a credit. It records increases for liabilities, equity, and revenue. Sample use of T accounts, and I've already kind of gone through and referenced some of this, is cash, increase here in terms of recording a sale. You have to account for the cash that came in for $20,000, and then you're crediting the revenue for $20,000. That's how you record a sale. Now, if you look at this, you're debiting cash. That is an asset, and in order to increase that, you have to debit that account. In order to increase your revenue, you have to credit that account. So again, essentially what you're doing here is you're increasing both of these, but if you look at the nature of the way this works, cash is a debit, revenue is a credit. An expense account, the way you capture those particular entries is a debit. Again, assets and expenses are debit accounts. In other words, what that means is in order to increase those, you have to debit those particular amounts. In this particular example, we're recording an expense for $3,000. We're going to take our expense account and debit that by $3,000. And then we're going to decrease our cash account because we have to pay for that expense out of our operating account. And we're going to credit that particular cash account. So again, credit, because it's an asset account, you're decreasing that particular account. That's how you record an expense. In this particular example here, you've got the accounting equation represented with all the historical entries that we have for the month of January. You can see on the left side, you've got the entries regarding cash, and on the right side, you've got the credits as far as it goes. So debits on the left, credits on the right. You've got a balance there for cash. You've got your balance there for accounts receivable, supplies, equipment. That is all within your asset classes. Then you've got your liabilities, which includes the accounts payable and unearned revenue. And then you've got your equity accounts. You can see that they're all represented vis-a-vis the double entry accounting system and coming up with balances that should tie out to your ultimate financial statement, in this case, the balance sheet. Another way to look at it is another tool that we accountants have. It's the general ledger. Now, the general journal and or the general ledger is a detailed record that shows every transaction categorized by date. In this particular case, we have a journal entry, or we have a general journal that is accounting for each particular account, its line item, and its debit or credit relative to that particular transaction. This is a historical ledger that allows you to look at all of the operating activity of the account and or the accounting system. And why it matters is because if financial statements are the big picture, the general ledger is the zoomed in version showing all the brushstrokes. In other words, again, I came back to the T accounts are the skeleton, and this is kind of the supporting structure that those T accounts are building. Financial statement analysis. What is financial statement analysis? Well, everything basically with regards to these financial statements, whether it's the P&L, whether it's the balance sheet, or the cash flow statement, you have to dig a little deeper and you have to kind of see what these particular statements are telling you. Again, like I said, this is the way to take the temperature of your particular business. Statement analysis usually has a purpose. The purpose of an analysis usually, again, like I said, understanding the financial trends, helps identify growth opportunities and potential risks. There's a term out there called KPI. So look at KPIs. What is KPIs? These are key performance indicators. They're very important in terms of certain line items that you want to look at, either through your income statement or your balance sheet that you want to look at and monitor on either a month-to-month or at least a quarterly basis, for sure a yearly basis. Profitability ratios are one of the biggest ones, right? Your profitability ratio is your gross margin. So that is gross profit divided by revenue. Again, we're speaking to the profitability of the business. All of this is essentially referenced out of the income statement. Net income margin is another one, which is net income divided by revenue. And then you've got liquidity ratios. Those are your current assets divided by your current liabilities. And we'll get into that here a little bit later. One of the reasons you want to identify trends and areas for improvement, obviously, it's pretty obvious. You always want to spot opportunities and challenges as they're coming up or as they're trending. And if your financials are telling you some of that stuff, you really need to pay attention. So here's the deal. Spotting opportunities and challenges don't always come easy, but your financial statements can help you get there. Revenue growth is one of the biggest ones. We're always looking for patterns in sales. Are we increasing? Are we decreasing in sales? Is it stagnant? Do we need to basically review and renew our marketing strategies or our sales strategy? Expense management. Rising expenses may highlight areas to cut costs or negotiate better terms with regards to your suppliers or your vendors. And then there's cash flow optimization. Again, if you can't pay the bills and you don't have enough cash to continue operating your business, you're not going to stay in business very long. So if liquidity is low, consider collecting faster on your receivables or reducing any unnecessary inventory. Setting improvement goals is always extremely important for any business. Using financial statements to attract investors. Let's go there. What does the investor mean? Well, it can mean a lot of things. You can basically go out and look for angel investor. You can go through and maybe look to have a business loan. A bank could be considered an investor, even though they're lending you money. They are essentially investing in your business as far as it goes, because they're looking at the fact that you're going to be able to pay that back as far as it goes. It showcases profitability and stability when you basically go through and you have those particular statements. Profitability trends are always good and important to show that it's consistent, then that you've got stabilized cash flow. Emphasize the growth potential. Market opportunities, use data to illustrate the business potential to expand, and also your financial strength. What lenders focus on in terms of securing loans is a healthy cash flow for one. Lenders always prioritize the businesses with a positive operating cash flow, which indicates an ability to repay the debt. So again, they're trying to see what kind of cash flow you've got to be able to make sure that they're getting paid back. Lenders are in it for a business, right? They're charging you interest for the use of their money, and they want to basically have a profit, so they want to make sure that you've got healthy cash flow to be able to pay for the loan. Debt management, you want to make sure that you have low debt to equity ratio or manageable debt levels. If you owe too much on the business or you're overly leveraged on loans, you're not going to make it. You're not going to be in business very long. Key financial statements for loan approval are your balance sheet, making sure that a healthy balance sheet shows a solid asset base and a low liability load. And then your cash flow statement, which again shows positive cash flow and reassures the lender that the business can cover loan payments. Applying accounting knowledge to drive decisions, whether it's budgeting and expense control, pricing and profitability, or cash flow management, these are all extremely key to making sure that you're able to make either decisions in the short term or the long term. We have a case study. The case study here is a plumbing company that we've already got an income statement, and it's showing a little bit of key indicators here. One of them is gross margin, and we can see here that this particular income statement runs through January to the end of October 2024. And we've got a total income of $705,000. We've got total cost of goods sold of $276,000 and To look at our gross margin percentage, we essentially take the total income and divide it by the total cost of goods sold. That, in this particular case, is coming up to a 39.25% gross margin. Now, the gross margin is important because you know that you've got a certain amount of gross profit that you're making after you're actually producing your good or service. That is reflected in the cost of goods sold. However, now you've got the expenses. That is the rest of the operating expense for your business. That gets you down to net income. In this particular case, we've got $149,025.09, which is essentially our net income, divided by the revenue, which is the $705,264.37. Our net income, after we take out all of the other expenses, after we take out COGS, is 21.13%. It's actually not bad. A 21% net income ratio proves that this particular company is making a little bit of money at the end of the year, or at the end of this particular period. Current ratio. This is another key indicator that is used to analyze not the profit, if you will, but essentially it's analyzing the balance sheet. And what that's doing is that's taking our current assets and dividing that by our total current liabilities. And in this particular case, you've got current assets of $57,820.69. Again, what is a current asset? Those are assets that are liquid to us and are available to us at the drop of a dime, if you will. So if I want to go out and pay somebody out of my cash account, it's there. Again, going back to cash is king. So our $57,820.69 is our current asset base. And then we've got total current liabilities. In this particular case, current liabilities really aren't that bad. We've got $532.77 that's owed on an accounts payable. Who knows, maybe that's some supplies or materials. You take the two, you divide them, and in this particular case, our current ratio is 108 or 108.52. That is a ratio that's being represented there. So again, we go back to the cash flow statement. And in this particular case, this is again showing what our cash flow position is. We've got our operating activities, we've got the net income, we've got adjustments. It comes down to net cash provided by the operating activities. We've got net cash provided by investing activities. And we're really coming down to the end of the period trying to figure out how much money, once we actually incorporate our operating activities, our investing activities, and our financing activities, how much cash do we actually have for this particular period? In this particular period, we ended up with cash at the end of the October 31st period of $54,764.57. Probably a pretty good cash position relative to what this particular company is doing in terms of activity. As you can see, there's a lot of different uses for the particular financial statements, and there's a lot of ways that you can analyze them. Recommendations for business growth and financial health. There's a few key things that you should focus on as a company. Make sure that you have financial meetings with yourself, your accountant, whoever's doing your books, your staff. Your employees are always crucial to kind of find out what's going on. Conduct monthly financial review meetings. If you've got an accountant, even if you've got a CPA or a tax advisor that you talk to, conduct monthly financial review meetings so you can track key metrics like profit margins and cash flow. It's extremely important. Doing that consistently is a very good practice. Focus on your profitability. Again, just like any other business, prioritize your high margin revenue streams. Consider price adjustments on products or services that aren't cutting the mustard, and make sure you can basically make sure that you're allowing for that service or product to be profitable. Have a team of advisors at your side. Like I said, build a trusted team of advisors. Work with your CPA, attorney, other financial advisors who can guide you toward informed decisions. Maximize savings and navigate potential risks. Reinvestment is something that a lot of businesses don't ever really think of, but you have to invest in marketing and team development for growth. Use the profits to enhance technology and process efficiency. That's not something that a lot of entrepreneurs think of because they're just so busy, or sometimes margins are so tight. But taking a little slice of that particular profit margin and reinvesting it for tomorrow always makes a lot of sense. And setting long-term goals. Define your 3-year or 5-year financial and operational targets. Where do you want to be in 3 years? Where do you want to be in 5 years? Are you looking at growing this exponentially? Are you looking to grow 50%? And then at the end of the day, most of us are in business to enjoy our lives, and maybe you don't want to be in business forever. So you have to make sure that you plan for an exit strategy or a business expansion. So just like when you go out and you buy a stock, you ultimately have to sell the stock to get that gain. think of your business in the same fashion. You're buying a business or you've created this business. If you want to retire or you want to basically move on to something else, you have to create an exit strategy. Whether that's a continuation plan with your kids or another partner, whatever the case may be, think about what your exit strategy is. At this point, I just want to say thank you. I hope that you've enjoyed this particular presentation. You know, for consultations, we have a scan code here that you can scan, take a little bit of intake from the SSBCI from west.org. It's been a pleasure. Again, my name is Luis Quinones. Have a good day and make it a profitable one. Take care.